Needless to say, with everything going on in the stock market recently, 2022 has gotten off to a bit of a bumpy start. With the Nasdaq having its worst week since 2020, it's caused a ripple effect across the entire US stock market. And although it's unlikely that these market conditions are going to persist throughout the remainder of the whole year, this did open up a lot of really good opportunities specifically for dividend investors. As of the making of this video, a lot of different sectors, including REITs and business development companies, saw their share prices fall so dramatically that it allowed for investors to pick up additional shares of high-quality dividend-paying stocks at greatly discounted prices. With that being said, there is one stock in particular whose share price fell so much over the last week, it's actually bumped the dividend yield all the way up to now over 17% according to Yahoo Finance. In fact, its share price fell approximately 8.29% in just the last week, which has given it a significantly cheap price tag. I'm talking about Orchid Island Capital, which is ticker symbol ORC. This is one of the most discussed stocks on my channel, and I see a lot of different people on various forums and subreddits talking about how they just love seeing these big dividends being paid out into their accounts every single month. But with such an astronomically high dividend yield, it sounds a little too good to be true. So in today's video, I really wanted to discuss this stock in particular, since right now it's currently offering such a high yield. I think it's worth asking the question, is this a great time to buy Orchid Island, or are there better options out there for investors searching for high yields? I also want to discuss how exactly this company functions, because I feel like a lot of people only look at the dividend yield when they invest in this stock, and they see that it pays monthly dividends as opposed to quarterly, which probably sweetens the deal for some people even more, but I'm concerned that a lot of investors might not even understand how this company makes money. So with all this in mind, let's take a deep look at this stock and try to determine if Orchid Island is worth holding in your dividend portfolio. If you're not too familiar with the company, Orchid Island Capital is a specialty finance company that invests in residential mortgage-backed securities, or RMBSs, on a leveraged basis in the United States. The company's RMBSs are backed by single-family residential mortgage loans, referred to as agency RMBSs. They've been in business since 2010, and they're externally managed and wholly owned by a company called Bimini Capital Management in Vero Beach, Florida, in what has to be one of the smallest-looking headquarters I've ever seen. Orchid Island is structured as a REIT, or a real estate investment trust. These are companies that own or finance income-producing real estate across a wide range of sectors. In order for a company to be qualified as a REIT, they need to meet a few certain requirements, which includes having to pay 90% of their earnings to shareholders in the form of dividends. They must also invest 75% of their total assets in real estate and earn at least 75% of their income from rents on their properties or interest on their mortgages. If a corporation can meet these requirements, then the company can be classified as a REIT, and as a result, they don't have to pay corporate income taxes. There's three different kinds of REITs that exist, with the first being equity REITs. These are companies that own physical properties and earn revenue by collecting rent payments from tenants who lease their properties. The second type of REITs that exist are mortgage REITs. These are companies that don't own any physical properties, but instead purchase or originate mortgages and mortgage-backed securities and earn revenue from the interest on these investments. And then finally, you have hybrid REITs, which own a mixture of both physical properties and mortgage products. Orchid Island Capital is a mortgage REIT, which means the company invests in residential mortgage-backed securities and makes money from the interest on these mortgage-backed securities. These types of REITs are pretty difficult to understand because they have so much more complex business structures than equity REITs. I think we can all understand the concept of owning property and then having tenants lease it and then receiving rent payments which are passed on to shareholders. But with mortgage REITs, these companies come with a whole host of additional risks, including leverage, sensitivity to interest rates, prepayment risks, as well as some others. My goal for this video isn't to explain in detail how exactly mortgage REITs earn revenue, because that would just be enough content to make a whole video in and of itself. So I'd strongly suggest doing a Google search on the topic if you really want to study this sector and how it works. For this video, I wanted to specifically look at Orchid Island and point out what I believe are the key metrics for this company that investors should keep in mind if they're considering investing in this stock. First of all, if we expand the share price performance of this stock, we can see a consistent downward trend for this company. Once trading at nearly $15 a share, as of the making of this video, this stock now trades at $3.87 per share. That's a nearly 74% decrease in share price in almost the last 9 years for this company. Additionally, this company has cut its dividends 6 times since being publicly listed, with the last cut being just 2 weeks ago. They've been able to keep paying dividends monthly, which is nice, but both share price and dividend distribution amounts have continued to decrease with time for this company. You might be wondering what your total return would be, though, if you chose to reinvest all of your dividends. Because after all, there's some securities such as QYLD that have a history of slightly decreasing in share price value over time, but they offer such massive dividends that a falling share price doesn't actually mean you're losing money on your investment. And if we look at what a $10,000 investment into Orchid Island 8 years ago would look like, we can see that technically you wouldn't have lost money. In 8 years, you would have made $1,185.69, or an average annual return of 1.41%, which is pretty awful when compared to other investments out there, but like I said, technically you wouldn't have lost money. But while doing my analysis for this stock, I was looking through the financials of this company and a couple things really stood out to me. One of the biggest things was the decreasing book value for Orchid Island over the years. Book value for mortgage REITs is a pretty important metric because book value is basically the net worth of the company. It's the total assets owned by the company minus the liabilities. And if they continue on this downward trend, I don't see how Orchid is going to be able to sustain their dividend at its current level in the future. They're simply not going to be able to bring in enough money in revenue in order to keep this high dividend yield in the long term. It's difficult to say how much longer they'll be able to keep it at 6 cents per share a month because this company also suffers from extreme swings in net income. What you're looking at is their 2020 annual report taken from their website. They don't have the results for 2021 published yet, but what I wanted to bring to people's attention is just how crazy these net income numbers get for Orchid. In 2020, the company reported a net income for the year of just $2.1 million. In the year before that, in 2019, the company reported $24.2 million in net income. But then before that, in 2018, the company reported yearly losses of $44.3 million. Now, to be fair, this isn't entirely out of the ordinary for mortgage REITs. Other companies in this sector like AGNC, as well as Annaly Capital Management, can also have some pretty wild swings in their income. But what I think makes things particularly worse for Orchid Island is just the extreme amount of leverage this company uses. Leverage is using borrowed money as a funding source in order to hopefully generate higher returns. But the more leverage a company uses means there's more risk, so remember that higher leverage means higher risk. According to their third quarter 2021 investor presentation, their leverage ratio was at 7.5. From what I was able to gather, the industry average for mortgage REITs is at about 6.5, which means that compared to other M-REITs in this sector, Orchid uses 15.3% more leverage. And in fact, historically, as you can see, a ratio of 7.5 is actually on the low end for them. At one point, they had a leverage ratio of almost 10, which is extremely higher than average. So on top of M-REITs being a riskier investment by nature, because of its higher leverage, Orchid Island is an even riskier investment within the M-REIT space. Another thing that I found interesting was I decided to look at the insider ownership percentage of Orchid Island on a website I like to use sometimes called Fintel to see what the percentage of the company is owned by company officers, the board of directors, and other higher-ups in the organization. A high insider ownership percentage typically indicates that the board is generally very optimistic about the company's prospects going forward. And what I discovered was that insiders only own about 0.36% of all outstanding shares of the company. This is one of the smallest insider ownership percentages I've ever seen for such a young company, which indicates to me that those who are in charge of the company don't even want to own too many shares of their own stock, which is worth taking note if you ask me. Typically with smaller companies, they have fewer shares outstanding, so it makes sense that these companies normally would have a higher insider ownership percentage. Realty Income's insider ownership is less at 0.23%, but they have 4 times as many outstanding shares, and they've been around for decades longer than Orchid. It just indicates that this company's management doesn't seem to have too much interest in owning shares of their own stock. So after taking into consideration everything we've looked at so far, what should our opinion be of this company? Is it possible to make money with ORC stock? Well, technically it is, as we saw earlier, as long as you buy in at a good time. Looking back to that graph, there have been plenty of opportunities to get in on this stock and you wouldn't have lost money. But remember, the returns were so poor that during that same period, there were so many other high dividend paying stock choices out there that would have returned much better results for you. To really drive home the point here, let's take a look at how your investment would have fared if you chose not to reinvest all of your dividends into buying more shares. You can see that you actually would have made even more money had you chose not to reinvest all of your dividends. You would have averaged a 2.33% annual return as opposed to a 1.41% yearly return if you reinvested your dividends. The reason this is even possible is because of both the diminishing share price and the dividend cuts over the years. Now, I totally understand that people love the big monthly dividends from this stock. After all, as of today, a $10,000 investment into Orchid would earn you $154.98 a month in dividends, which is amazing. And high dividend income investing is really what my channel revolves around, but in the case of Orchid Island, I just don't ever plan to become a shareholder of this company because I don't think that things are going in the right direction for them. I hope I'm wrong, and it's ultimately your choice if you prefer the high monthly dividends, but I'm just not willing to take the risk with this stock, because I ultimately just see more problems for them in the future. If you want more high-yielding dividend stock ideas, feel free to check out some of the other content on this channel. You'll find plenty of videos talking about stocks, ETFs, closed-end funds, and more that yield 6, 8, 10, and even 12% or more that I think are better options than this. Alright everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below and click subscribe if you want to see more dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that content. Alright everyone, thanks again for watching, and I'll catch you next time. Take care.